Okay, today we are going to be dissecting the concept of capital budgeting and give and take. This topic will take us for the next uh, at a minimum, 4 weeks, or that's practically a month for us to be able to do justice to it. Now, it's been a while that ICAN tested a complete question on capital budgeting. The last time was 2021. I think it was May 2021 when students were asked to calculate um, internal rate of return. I think that was the last question on capital budgeting. Ever since then, it has always been valuation as compulsory question. Okay, so of course, majority of you in this class, you're already aware of what capital budgeting is. And that was what I was saying the other time, that we are going to be faster relative to where we are coming from. All right. So what do you understand by capital budgeting? You can simply say capital budgeting is also known as investment appraisal, capital expenditure, or capital investment decision. Whichever one you want to call it is the same thing. So it involves the process by which an organization commits its funds into long-term projects. Long-term projects are projects that span over one accounting period. Any project that will last for more than 12 months are capital projects, including construction of roads, bridges, dams, refineries. All right. So any project that will last for more than 1 year are what is known as capital budgets or capital projects. Generally, it is expected that the management of a company will utilize the limited scarce financial resources of the company to undertake a project that is capable of increasing the value of the company, because the primary purpose of any organization, of every profit-making organization, is to increase the wealth of the owners. So if the company is able to generate profit, certainly the wealth of the owners will increase by that amount of the profit. Therefore, the expectation is that the management of a company will commit the limited scarce financial resources of the business to undertake investment opportunity that will increase the value of the company and which will invariably maximize the wealth of the owners. All right, using relevant investment appraiser technique. So it is expected that for a company to be able to commit the limited scarce financial resources into a project, you have to evaluate it. You need to appraise the project to be sure that it is financially viable. All right. So that is basically the essence of the topic that we want to discuss. So what are the procedures involved in capital budgeting decision? There are 6 different procedures that you can carry out. I can crash it to 4, but technically, there are 6 different procedures that you need to carry out anytime you want to determine, you want to carry a capital budgeting activity. All right. The first step is to identify a possible investments. Okay. You identify possible investments. You scan the business environment to be able to identify the investable opportunity that the company can commit its resources on. There are some departments, okay, for example, depending on the size of the organization, the marketing departments, research and development of business service unit of the organization may be they are the one responsible to scan the business environment to be able to identify those investment opportunity. All right, a whole lot of activity will go into that. But the bottom line is that once the opportunity has been identified, management meeting will be convened to discuss the outcome of their findings, and then at that moment in time, another department head, which is the finance, will be required to go ahead and evaluate the project, whether it is financially viable or not. All right. So this is where you have responsibility. All the parties within your department, within the finance and accounting, that will participate in the evaluation of the project. All right. So you need to carry out your financial viability of this project to ascertain whether the company should commit its limited scarce financial resources. All right. Again, if the project is whether the project is financially viable or not, the finance director, which is the head, or the CFO, or finance manager, or finance supervisor, depending on the size or the structure of the organization, we need to report to the management on the outcome of the evaluation. All right. So if it is financially viable, it will be advised that the company should go ahead to execute the project. If not, then the project will not be undertaken. All right. Then, of course, if the project is financially viable, then we then need to move to step number 3. Step number 3 is authorization, selection, authorization, as well as the approval of project. Okay. So the project will be, if the project, like I said, if the project is financially viable, then the management will give a no exemption taking. All right, because the appropriate person within a designated person within the organization that has the qualification, experience, and expertise to evaluate the project, which of course you are the one because this is your call. All right. So the appropriate delegated authority or responsible person within the organization has advised the management that they should go ahead because as an expert. All right. So this is where you need to shine. Okay. So of course you are going to have management meeting for you to be communicating your outcome. So because the project is financially viable, so the management will have to give a no exception taking. The only thing that can delay the commencement of the project if the financial or if the funds or the financial resources required is not readily available. That's the only thing that can delay it. But if the funding is available, of course, there will be approval. I mean, even if they approve, the only thing is just that they will not mobilize until the funds is available for a start. Okay. So after management approval, we then go to step 4, which is development and execution of projects. This is the point, or this is the stage whereby the company will mobilize people and equipment to sites. Whatever the contractor that the company is going to use would have been agreed long before the final approval for the project. All right, because you need to know, all those processes, you don't wait until you have the final approval before you begin to seek for contractor that will do the job. So of course, every business organization, depending on the size, we have a capital budgeting committee. All right, and also subcommittee that will be in charge of sourcing for contractor and how the job will be done and all of that. Of course, everything that's going to be done must be consistent with the company's capital budgeting guideline. All right. So then after the project has begun, activity has started on site, then the next thing that the company will need to do is to monitor and control the activity of the people on site, the resources, and also to ensure that you don't go above your budget. Now, when you talk about monitoring, all right, depending on the size of the organization, when you are selecting your contractor, there will be a contract agreement between the two parties, between the company and the contractor. So this is where you need to have an alignment. So you must ensure, as a responsible organization, you have to ensure that the contractor And you yourself, as a responsible, as a corporate citizen, you need to, everybody, all,
especially from treasury and not the actual debt itself.
Bukumi Babadmos, well done. Continue to describe my class. Well done. So, the monitoring and controlling, when you talk about monitoring, the company will have its own people on site, the engineers, the QS, quantity surveyors, all the responsible professional that are needed on site at that particular point in time. They will be there to monitor the activity of the contractor, because an average contractor will want to maximize margin. Okay, they want to maximize margin and they will try to cut corners. They want to follow shortcuts. So if you don't have your own people on site to monitor the activity of the contractors and also the people on site, certainly the company may have it may have their consequence at the end of the day. So in order to maintain, in order to protect your corporate image as an organization, in order to ensure that you get value for your money, you must have your own people on site to monitor the activity of the people and then of the contractor. If the contractor has quoted in the contract that they are going to use 5 bags of cement, for example, you need to be there. Your own people must be, your own representative must be there before they begin anything in that particular morning, ensuring that, okay, you said for this particular task that you want to do, all right, for this stage of this project that you want to do, you said you are going to need 5 bags of cement. Oh yeah, bring it out. So you'll be there, they will do the mixing, your presence, you will ensure that they are using the right quality and quantity of material. Not that contractor will say, we need 5 bags of cement. They will quote 5 bags of cement, but they will end up using 2. At the end of the day, they will do a shoddy job, and then before you know it, the building will begin to crack and then eventually collapse. And we don't want that to happen. For some of you that are living in Lagos, particularly on the island, you will, for if you are around, if you are around Lagos around about 4 or 5 years ago, around February 2022 rather, in February 2022, there was what we call Ikoyi Gate. As at that time, a particular high-rise building, uncompleted building that collapsed. You know, why did the building collapse? So many factors were responsible. You know, uh, they got approval from Lagos State government to build a 16-story building, and then they increased it from 16 to 21. You know, so on this fateful day, and then the building gave in. All the people, almost 50 people, died in the incidents. All right, so you can imagine, including the owner of the property. People's money, my money, your money that you kept in the bank, were borrowed to finance the project, and everything gone just like that, because of the fact that some individuals were trying to cut corners, you know. So this is what we are saying. So as a responsible organization, you don't want such a thing to happen. As a corporate citizen, you must ensure that the right thing is done at the right time. So you must be there to monitor the activity of the people on site, because you have to protect your corporate image. You can imagine if the owner of that property were to be alive today, I'm very sure the person will still be paying compensation to the family of those that were lost. You know, I can imagine how he's going to face the government after all that happened. I can imagine what he's going to tell the creditors, all right, where he has borrowed money to finance and everything is gone now, you know. So this is what we are saying. So you have to protect your own image as a corporate organization, as a responsible organization. All right. So that is as per monitoring. Under monitoring also, you have to safeguard the equipment on site, because the contractor has brought some equipment on site to work for you. So you have to protect it, you have to secure it. All right. You have to provide security on site. Not only about the equipment, even the materials. Okay. you also need to safeguard, you also need to protect the people on site. So you have to ensure that the right quality and quantity of materials are used. Where contractor has told you that they are going to use scaffolding, some contractor may want to use ladder instead because the cost of renting scaffolding is higher relative to ladder. And you know that you have to consider safety. You have to consider, or you have to put into consideration the safety of the people on site. You know, so that's why you have to ensure that they are using the right equipment, the right PPE, all right, to protect themselves. Because if anything happens to anyone on site, the company will be held responsible. Media will be there to cover the incidents, and then they'll be shouting, they'll be saying bad things about the company. That can damage the reputation of an organization. And that's why it is important you have your own people in there to monitor the activity of the people on site. The other part of this step is controlling in the sense that you need to control your costs. The limited scarce financial resources is not sufficient. It's very little, and you are managing it, and you have to use it judiciously. So to do this, to control your costs, you must ensure every project must have a budget, right? So you are going to be comparing your actual spend with the budgeted estimate. So you must align, your spend must align with the budget. At any point in time you want to go above your budget, you need to inform the management. In fact, periodically on a monthly basis, you are supposed to present your stewardship, the stewardship report of the project. Again, this is where your team, the finance team, have responsibility. All right, because you are the one that will be preparing the financial stewardship to the management, because management must be aware of the project status on a regular basis. So for you to be able to do justice to that responsibility as a finance person, you have to work hand in hand with the project people. You are not engineers. You are not the engineer that are doing the job. You don't have any responsibility on site. You are just recording figures. But that notwithstanding, once in a while you need to go to the site, to go and visit the site, go and check what the contractors are doing, what the engineers are doing, so that you know you are going to have first-hand information about what is happening on the project, so that when you are speaking with the management, you'll be able to relate the project with the cost. And then, like I mentioned, you need to work with the engineers, you need to work with the project team to be able to get updated, relevant information, because you can't just be recording costs. You can't just be recording the project financials without understanding the story behind the project. And that's why you have to work with the project team. They are the ones that are buying material, that are recruiting labor and all of that. They know the status of the project. So when you work with them, you have good relationships, so that you'll be able to get first-hand information, the project status from foundation to whatever the stage of the project. You have to have that first-hand information, so that when you are presenting to the management, you are going to be attaching the cost to the project, because every project, the cost, the spend of the project is attached to a particular task or particular activity. So at that point in time, you need to know which of what do you want. Before, when they are seeking for fund, you need to ask, what do you want to use this money for? Oh, this is the stage we are right now. We are doing the foundation. In the foundation, this is that, this is what we need, and this is what make up the total funds that we're looking for. So that by the time they begin to spend those money, you'll be able to tie it to the information that you have. All right, so that you are not just an ordinary accountant or ordinary finance manager, finance supervisor, finance director. You are just there in the office. You are putting on tie, you are enjoying with in the AC without even, you don't even know much about the project. You can't be relevant if you are. In fact, at times you take the shine away from the project people. All right, because you already understand the status, you know what they are spending money on. So you need to shine, because management will not appreciate your efforts if you don't align the spend with the project activities. All right. So these are the things you need. At all time, you must ensure that you don't go above your budget. If you want to go above your budget, you need to inform management beforehand. You don't just spend money before you, you don't say, okay, because you need to, it may well be, of course, market condition, prevailing market condition can make the project cost to go above the budget. However, you need to be proactive because you are monitoring your cost. You are controlling your cost to be sure that you don't go above. But there will be some circumstances that will make the actual spend to be above the budget. For example, if there is what we call extension of time, okay, like what happened in 2020 during the COVID-19, there was no move, there was restriction of movement for some specified period for some months. You know, you can imagine if you have project activity that are going on during the period, right? And then there's restriction of movement. You are unable to access you have to access sites. So in that case, you need to recover the lost time. So there will be an extension. Anytime there's an extension of time, there's likelihood that your cost will go up. At times also, there may be change in scope. Maybe there's something you have already included in the contracts that you want to do, but because of management, I mean, there's a change that's okay, that thing is not needed again. That can reduce your cost. Or maybe there is something you don't have in the project in the contract before. Now you want to introduce it in the project. So in that case, you are adding to the existing cost. So that means your cost is going to go up. All right. So these are the things you are going to that can warrant the actual spend to go above your budget. Of course, inflation is also part of it. All right. So let's move to the final one, which is the post-completion investigation. All right. So Jeremiah, be careful. Yes, the final one is post-completion investigation. The essence of post-completion investigation is to ensure that the objective at which the project is being undertaken has been achieved. During the course of executing the project, there will be lessons learned. All right. These lessons learned will need to be documented in order to prevent future reoccurrence. It may well be that the project manager that executed the project is no more with the company, right? So that's why it is important to document all the mistakes that were made during the course of executing the project. This is intended to aid organizational learning. All right. Okay. So may also be that it may well be that there is a section of the project, there's a defect in the section of the project. So you need to call the contractor to come and fix it. And that's why in every contract, there's always a retention fee that will be inserted. All right. Retention fee is a specific sum of, I mean, percentage of the contract price. Okay, that will be retained until a specified future date. In case there is anything, I mean, there is area of the project done that is not too okay, you may invite the contractor to come and fix it. But if you have paid the contractor 100% of the contract price, there will be no motivation to come back again to come and do it. And that's why you have to retain that percentage. It could be 2%, it could be 5%, depending on the agreement between the two parties. All right. It could be for 6 months. The project, I mean, the retention fee can be delayed for like 6 months or a year or even 2 years. So depending on the agreement between the two parties. All right. So but the most important thing is that when you are executing the project, you are going to learn so much lessons, and then that lessons will need to be archived, will need to be documented so that it will aid organizational learning. So these are the procedures involved in capital budgeting decision. The next thing we are going to discuss is the characteristics. It's something you can read on your own. I don't need to be talking about all of this. They're in your notes. So let's dive into discussing where you have major work. All right. Ordinarily, like I mentioned earlier, ordinarily, I was supposed to just talk about a few things, maybe about 30 minutes, just to wrap it up. Then we begin illustration. But that's not my nature. Taiwo, well done. Oh. I don't know why you guys are
No, sir.
stressing me.
Good evening, sir.
If you want to talk to me, please. If you want to ask me any question, always raise your hand. You know the rule already. What page? Go to your learning material and just search for capital budgeting. Just search for capital budgeting. Glory. Yeah. Okay. Now, the next key area we want to discuss is project evaluation method. All right. How do you evaluate projects? When you want to carry out financial viability of a project, what method are you supposed to use? All right. One thing you need to understand is that the method to use will depend on the capital budgeting guideline of the organization, because a responsible organization, especially the big ones, we have a capital budgeting guideline and policy that will dictate how project activity should be carried out. Okay. So somebody have answered you. Some say page 39, page 37, whichever one. All right. So let's talk about methods of project evaluation. Basically, there are two methods of project evaluation. We have discounted cash flow method and two non-discounted cash flow method. Please open to the material at your end. I will just be speaking through. Okay. So the first one is discounted cash flow method. The discounted cash flow method is a method that uses time value of money and the timing of cash flows. The discounted cash flow method is the method that consider time value of money and then cash flows. What do I mean by this? The time value of money denotes that the value of 1 naira of today is worth more than the value of 1 naira tomorrow due to price level changes, that is inflation, as well as investors' preference to have their benefits now rather than keeping it into the future, or rather than delaying it into the future. That is time value of money. You can see because of inflation, the value of 1 naira today will be worth more than the value of 1 naira tomorrow. If we have 100,000 naira about a year ago, what 100,000 naira can buy is not the same thing today because of inflation, right? So time value of money is saying that the 100,000 naira you are going to earn in the next 1 year, what is the worth as of today? What is the worth now? That is, you are bringing the future to the present. So for you to be able to do that, you are going to discount that your cash flow. You discount the cash flow to the present value equivalent. So when you are doing that, you are simply simply considering time value of money. You are considering time value of money. And that's why we said that the time value of money is a method that's considered discounted cash flow method is the method that consider the time value of money and the timing of cash flow. Okay, what are the methods under the discounted cash flow method? All right, we are going to discuss the net present value method, which is the primary method. Then we are going to discuss internal rate of return. All right, you're already familiar with NPV as well as the internal rate of return, because we did that under the cost of capital. Then profitability index. Of course, profitability index may not be in your syllabus, but again, it's very straightforward. Net terminal value, this is not common. we have modified internal rate of return. Then after modified internal rate of return, we also have project duration. Okay, we have project duration. Then we have adjusted present value. So, of course, we are going to discuss the NPV, the IRR, the modified internal rate. The only two we are not going to discuss is the profitability index and the terminal value. All right. So let's start with the net present value. Okay. When we are done with the discounted cash flow, we then discuss the non-discounted. So what do you mean by net present value? The net present value represent the difference between the present value of cash inflow and present value of cash outflow in capital investments. NPV is considered to be the overall of investment appraisal techniques. Okay, it is considered to, it is adjudged to be the best of all investment appraisal technique. Why? Because NPV is an absolute measure of profitability, and it is a technique that is consistent with the shareholders' wealth maximization objective. This is because a positive NPV will increase the value of the company, and which will invariably maximize the shareholders' equity value. Okay, and that is why NPV is considered to be the best of all investment appraisal technique. That is in theory. Okay, all right. So that is basically NPV. How do you then estimate NPV? There are two different ways you can calculate NPV. You can use formula. You can also use tabular method. Whichever one you use, you are going to get the same answer, except to a rounding error. Okay. So if you are already familiar with this table to calculate NPV. This is the same table we normally use to calculate NPV under the cost of capital. However, if you want to calculate NPV using the formula, let me do it this way. Alternatively, I was avoiding typing things, so because I know I will be slowing down. Alternatively, the formula below, the formula below can be used to calculate net present value. Okay, what is the formula? Let me remove both. So if you want to calculate net present value, let me see. NPV will be calculated as, let me go and bring formula out. This is what I don't want to do before. Do I need brackets? Yes. Let me start with brackets. Then I will need this. Okay. Let's copy this. All right. So to calculate NPV, it will be calculated as, okay, I can even use the single one instead of double. Let me see first. So to calculate NPV, you are going to pick the cash flow of the first year. All right. You divide it with the discount factor. All right. Discount factor of the first year, 1 plus R raised to power. Let me change this one to, I hope it will. Okay. Okay. All right. So raised to power year one. That is, you are using the cash flow of year one. We discount it with the discount factor of year one. So that will give you the present value for year one. You continue like that until you get to the final year. Okay, plus due for year 2, cash flow, you pick the cash flow of year 2, you divide it with the discount factor of year 2. You continue in that order for year 3. All right, cash flow of year 3 divided by the discount factor of year 3. So you continue until you get to the final year. Okay, plus the final year. So this will be cash flow of the final year, which is denoted as N divided by the discount factor of the final year. All right. So the first one, all this one that has all the total, whatever you have here, will give you the total present value of cash inflow. You then less cash outflow. All right, less cash outflow. Your cash outflow is your initial outlay. So that will give you at the end of the day, the difference between the present value of cash inflow and the present value of cash outflow will give you the NPV. Let me even put it here. You know, we said that don't stress me, that's your problem. You know, we said that NPV is calculated as present value of cash, the difference between present value of cash inflow and the present value of cash outflow. That will give you your NPV. So this definition is what I've expressed in this formula. So where CF equal to cash flow or cash inflow for each year, cash inflow of each year. Then of course R equal to discount rate okay, turn this one to small letter r. Then of course N equal to useful life equal to useful life. Then CO equal to cash outlay, cash outflow or initial outlay. All right. So like I said, whether you use the tabular method or you use the formula, you are going to get the same answer, except for a rounding error. All right. So when you are calculating your NPV, you have to start with a positive cash flow, like in these hypothetical figures you have in this table. All right. The initial outlay is 1,000, usually in year 0. For the benefit of those people that are joint friends, that's what I'm doing this. I don't need to be doing this. Then you pick your cash inflow for year 1. In this case, is 550. Our discount factor is 10%. Our cost of capital is 10%. Then discount factor at 10% for year 1 is 0.909. You multiply with 550. That will give us 500. Then for year 2, cash flow, 615. Discount factor for year 2 at 10% is 0.826. That will give us present value of 508. So we said that NPV represents the difference between present value of cash inflow and present value of cash outflow. So at all time, when you are calculating your NPV, you have to start with the positive present value. So positive present value minus the negative present value will give you the NPV of 8. So this is how to calculate the net present value. So the next thing we need to discuss is the decision rule for net present value. What are the decision rule? For independent projects, accept if NPV is positive, okay? But if NPV is negative, you have to reject the project. Where NPV is equal to 0, you can either accept or reject the project depending on other qualitative factors. All right. Now, for mutually exclusive projects, you will only accept any projects with a higher positive NPV. Let's say, for example, you have project A and B. All right. So you said any one of the two projects that has a higher positive NPV will be selected. Therefore, what do you understand by independent projects? What is independent project? What is mutually exclusive project? Let me quickly give you independent notes. Okay, notes. Independent projects. It's a standalone project. Standalone project that may be accepted or rejected based on his own merits. Okay? Independent projects is a standalone project that may be accepted or rejected based on its own merits. For example, because if examiner asks you to explain or to discuss, you have to give example. For example, if a project produced a positive NPV, it will be accepted. But if negative NPV, it will be rejected. It will be rejected. So that is what is known as independent projects. It is a standalone project that may be accepted or rejected based on its own merit. The second one is mutually exclusive projects. Mutually exclusive projects. Let me push this one down. Okay. What do you mean by mutually exclusive projects? These are computing projects. These are computing projects in which the acceptance of one will preclude the acceptance of the other. That is, they are projects that cannot be accepted, together. For instance, if projects A and B are mutually exclusive, The acceptance of project A will result in the rejection or will result in the rejection of project B and vice versa. So this is what is known as mutually exclusive projects. Projects that cannot be accepted together are mutually exclusive. All right, just in case you are asked. All right then, so that is that about NINE present value. You can do your best to read about the advantages and disadvantages. Examiner cannot be asking you at this level, but you never can tell. Examiner may want to help you, giving you a bonus as a bonus. So no matter how cheap is a question, if you don't know, you don't know. All right, so do your best to master them. And I believe at this stage, since you did financial management, would have that thing uh, should still be dancing in your memory. Okay. And for those of you, in case you don't know how to calculate discount factor, this is the formula. We have done it severally under cost of capital. So you can either calculate your discount factor using this or use the other one. It's the same thing. All right. Then, of course, annuity formula. You already know this. We have discussed it in the past. All right. So, but if you want to calculate present value to infinity, if you want to calculate present value to infinity, this is the formula you are going to use. All right. If you are not given this, you are not given useful life in the question. You are just told that your cash flow, the project will generate cash flow to infinity, to perpetuity. Then in that case, it will be your cash flow divided by the discount factor. That will give you the present value to infinity. If you want to calculate annuity factor to infinity, or you want to calculate discount factor to infinity, it will be 1 divided by the cost of capital. All right. So if, for example, cost of capital is 10%, that will be 1 divided by 0.1. So if cost of capital is 20%, it will be 1 divided by 0.2. That will give you the annuity factor to infinity. All right. So those are basic things as far as NPV is concerned. So let's move to internal rate of return. Please, at any stage of my explanation, if you need any clarification, always raise your hand. All right. Okay then. So what do you understand by internal rate of return? The internal rate of return is also known as break-even rate of return, market discount rates, or yield to maturity. Okay, it can be called break-even rate of return, market discount rates, or yield to maturity. The internal rate of return is the rate of return that equates the present value of the expected future cash flow to zero. Any discount rate that produces zero NPV, that is the internal rate of return. The internal rate of return makes use of a trial and error method of interpolation. When you are that simply means is that when you are calculating internal rate of return, you have to adopt iteration. You use trial and error method. All right. So there are 3 steps they are going to carry out anytime you want to compute internal rate of return. The first step is to assume 2 discount rates that will produce 2 opposing NPV, like we did under cost of capital. You assume 2 discount rates. Examiner will not give you the discount rate. Anytime you are asked to calculate internal rate of return, you are the one that will assume the discount rate to be used. All right. Examiner will not give you, because that is the peculiarity of IRR. So you assume 2 discount rates that will produce a positive and negative NPV. Then step 2, you calculate internal rate of return using the internal rate of return formula. Okay, you're already familiar with this formula. We have done this under cost of capital. Then step 3, you advise whether the project should be undertaken. That's the final step. All right. So what are the decision rules for internal rate of return? For independent projects, you accept if internal rate of return is greater than the company's cost of capital. Anytime you want to advise on the basis of internal rate of return, you have to benchmark, you have to compare your calculated internal rate of return with the company's cost of capital, because the cost that the company is paying on the capital contributed into the business must be lower than the internal rate of return that the project will generate. So if the project generates a higher return, of course, it means the project is financially viable and should be considered. But if the internal rate of return is lower than the company's cost of capital, it means that the project is not financially viable and should not be undertaken. That is for independent projects. For mutually exclusive projects, you are signing projects with a higher internal rate of return, provided it is higher than the company cost of capital. All right. So, like I mentioned, anytime you are calculating, you want to determine financial viability of a project using internal rate of return, you have to benchmark your calculated IRR with the company's cost of capital. That's what you need to do. Okay. So that's basically about internal rate of return. We have done this in the past, so just to mention it again. Now, at this level also, you need to understand the areas of conflicts between decision of NPV and the decision of internal rate of return. All right. So where there are mutually exclusive projects, the decision of NPV may be conflicting with the decision of internal rate of return, because net present value can suggest a particular project and internal rate of return may favor another project. This is an apparent conflict between the two techniques. So what are the causes of conflicts? How do you resolve the conflicts? So let's discuss it. All right. So the major reasons or causes of conflict between NPV and internal rate of return include significant difference in the capital outlay. All right. So if the initial outlay of the two projects are significantly different, then in that case, the decision of NPV may be conflicting with the decision of internal rate of return. I'm going to use hypothetical figures to demonstrate this. Just give me a few minutes. All right. Then the second reason for conflict is a problem of difference in cash flow patterns. All right. So a project that generates a higher positive cash flow at the earlier stage of the project may be favored over the project that generates a higher cash inflow at the latter part of the project. Okay, because discount factor at the earlier part is usually higher than the discount factor at the latter part of the project. Okay. Then, of course, difference in useful life or unequal expected life of the project can also result to conflict between the NPV as well as the internal rate of return. So let me give you hypothetical figures. Who wrote this thing on my screen? Let me stop sharing. Okay. So let me use these hypothetical figures to explain these causes of conflict. Let's say, for example, should I need to? Okay, let me use a table. Let me use a table to demonstrate this. Okay. Project A, project B, then discount factor. All right. So let's say we have project A, we also have project B. So let's say we have discount factor here. All right. Let's say project A. So let's say the useful life or initial outlay. Let's say we have initial outlay of project A to be 500 million. Initial outlay of project B, 800 million. Then, of course, you are given number of years. Okay, you are given number of years. For year one, cash flow of project A is 300. Year two cash flow is 250. Year three cash flow is 180 for simplicity. All right. Then for project B, year one cash flow is 100. That's cash inflow. Year two cash flow is 180 million. Year three cash flow is 220 or 200 million. Year four cash flow is 350 million. And then year five cash flow is, let me make this one to be 350. Then this one 300. All right, so nothing. Project A does not have cash flow in year 4 and year 5. Let's say we have discount factor. Let's say we have discount factor of 10%. So discount factor at 10%. Just to demo, I'm using this to demonstrate the areas of conflicts or what is causing the conflicts. All right, so discount factor in year 0 is usually 1. In year 1 at 10% points 909. Year 2 is 0.826. Year 3, all right, year 3 is 0.751 at 10%. Year 4 is 0.683, and then year 5, 0.621. Now, the first reason for conflict between NPV and internal rate of return, we said when there is significant difference in the amount of capital outlay. When you look at this project A and B, you will notice that project A has 500 million cash outflow, all right? Whereas project B has 800 million capital outlay. So the difference of 300 may be causing conflict between decision of NPV and decision of internal rate of return. Okay, so that is what I mean by significant difference in the size or capital outlay of the projects. The second one says problem of difference in cash flow patterns. When you look at project A generates a higher cash inflow at the earlier parts. Then at the latter part, the project generated 180 million, which is lower relative to the earlier part of the project. When you compare this to project B, you will notice that project B has a lower cash inflow at the beginning, at the earlier parts. Meanwhile, at the latter part of the project, it starts generating a higher cash inflow. And you notice that at any discount factor, okay, at any discount factor at the earlier part is always higher than the discount factor at the latter part of a project. Therefore, any project that has a higher positive cash inflow or any project that has a higher positive cash flow at the earlier part may be favored over the project that has a lower cash inflow. So this is what I mean by difference in pattern of cash inflow. Then the third one is difference in useful life or unequal expected lives of the project. When you look at project A has 3 years life. whereas project B has 5 years life. Project B has opportunity to recover more. Okay, has extra 2 years to recover more cash inflow. All right. So project B may be favored as a result of this. Project B may be favored over project A. So these are the reasons that can make NPV to conflict with the decision of internal rate of return. So in case you are asked to explain the areas of conflict of between NPV and internal rate of return, this is what you are going to say. And also in order to drive home the point, that's why I have to use these hypothetical figures to do the explanation. Let me just call it for example, so that you don't think it's part of your notes. All right, so I'm only using this one as an example, just to explain, just to demonstrate areas of conflict. So examiner can then ask you, how do you resolve the conflict between NPV and internal rate of return? Pay attention. You will recall earlier when I was explaining NPV, I said that NPV is a technique that is consistent with the shareholders' wealth maximization objective, because a positive NPV will increase the value of the company and which will invariably maximize the shareholders' equity value. So where there is conflict between NPV and internal rate of return or any other technique, at all time, your decision should be based on the net present value. I repeat, how do you resolve the conflict between NPV and internal rate of return? So where there is a conflict between NPV and internal rate of return or any other technique, your decision should be based on the net present value. Why? Because the net present value is a measure of profitability, and it is a technique that is consistent. It is a technique that is in line. It is a technique that is in consonance with the shareholders' wealth maximization objective. Therefore, when ranking mutually exclusive projects, when ranking mutually exclusive projects, the decision must be based on the net present value, because net present value is more reliable relative to internal rate of return when ranking mutually exclusive project. So this is how to resolve it. All right. And then anytime you have to calculate in a question, you have to evaluate or you have to determine the financial viability of a project. An examiner did not tell you any method to use. You don't need anybody to tell you that you are going to use the net present value. Why? Because NPV is an absolute measure of profitability. You can see it. If your NPV is positive, that is naira amount. So that means that the wealth of the shareholders will increase by your amount of net present value. And because NPV is in consonance with the shareholders' wealth maximization objective, that is why at all time, anytime you have to evaluate, you have to use net present value, except examiner asks you to use another method or another discounting method. At all time, it has to be based on the net present value. All right, it is a given. Okay, so that is that. So far, so good. We have discussed introduction to capital budgeting, right? The procedures involved in capital budgeting. We are currently discussing the methods of project evaluation. We started with discounted cash flow method. Under the discounted cash flow method, so far we have discussed net present value. We have also discussed the internal rate of return. So we are moving to modified internal rate of return. After modified internal rate of return, we are going to touch base with project duration. Then after project duration, we are going to discuss discounted payback period, and that will be the end of discounted cash flow method. The other part, which is adjusted present value, so it's something we are going to dissect in details when we get there, but not today. All right. So what do you understand by modified internal rate of return? what do you understand by modified internal rate of return? Now, there are some issues associated with internal rate of return. The first one is that the fact that is very subjective. Internal rate of return is subjective because you are the one that will assume the discount rate to be used to calculate internal rate of return, and it can produce ambiguous results. So it's in between two, usually in between two figures. So the internal rate of return is not exact. It will be in between two extreme figures. And that's why it usually produces ambiguous results. And then that's one of the limitations of internal rate of return. So as a result of this, the modified internal rate of return is developed to correct all the anomalies associated with the internal rate of return. Now, when there are unconventional cash flows, okay? When there are unconventional cash flows are cash flows that include both the positive and negative numbers. So when you have positive and negative cash flow in between years, then those are unconventional cash flows. For example, in year one, the project generates a positive cash flow. In year two, the project generates negative cash flow. In year three, the project generates positive cash flow. Year four, positive cash flow. So when you have a mix of negative and positive cash flow, that is what we call unconventional cash flow. So when there are unconventional cash flow, it is not appropriate to use the internal rate of return as a decision criterion. Why? Because the internal rate of return will not be consistent, okay? We will not be consistent or will be in conflict with the decision of net present value. So if internal rate of return is conflicting with net present value, it means that the internal rate of return is not in line with the shareholders' wealth maximization objective. So generally, the assumption behind NPV is that the cash flow generated by project can be reinvested at the company cost of capital. You know, when you invest in a project, let's say, for example, you have invested 500 million naira in a project, your expectation is that at a later future date or at a later future date, this project will you are going to reap benefit from the project. All right. So those benefits are your cash inflow. Okay. So the cash flow that you get, that the project will generate can be reinvested at the company cost of capital. Let's say, for example, you are into real estate, right? You have developed a project and you spend 500 million naira. You then rent it out. Every year you are earning rental income. All right. You are earning rental income 20 million, 50 million, 100 million. Every year you are earning rent. So as you are earning, so you believe those cash flow you are earning from the project that the project is generating, you want to reinvest. Your assumption is that you are going to reinvest the money. You are going to recoup the money. All right. So you will reinvest the money into another project. So when you are reinvesting it, you are supposed to use the company cost of capital to do that. Okay. So that is the assumption behind the net present value calculation. Whereas the internal rate of return is saying that no, the cash flow generated by the project should be reinvested at internal rate of return. This is a conflict. All right. So, and that is why the modified internal rate of return is developed, okay, in order to correct the anomalies associated with the internal rate of return. So the modified internal rate of return will allow decision maker to specify the reinvestment rate to be used for the receipt and payments associated with the project. All right. So, and then modified internal rate of return is a technique that is consistent with the shareholders' wealth maximization objective. So the modified internal rate of return assumes that the cash flow generated by the project should be reinvested at the company cost of capital or a specified reinvestment rate. Okay, so that is the modified internal rate of return. How do you then calculate modified internal rate of return? To calculate modified internal rate of return, there are two methods that you can use. Let me see here. Let me give it to you. There are two methods that you can use to calculate modified internal rate of return. You can either use terminal value method. Let me put it down for you. Methods of calculating modified internal rate of return. Okay. So, like I said, there are two methods. The first method is terminal value. Terminal value method. Then the second method is present value. Present value method. So let's bring it out one after the other. The first one is terminal value. Terminal value method. What are you supposed to do? What are the steps? Under this terminal value method, step one, let me just go straight to the point. Okay. Step one, let me do it this way. Let me make it bullet points. All right. So step one is to calculate, all right, or identify or let me shorten it. Calculate terminal value. Calculate terminal value for positive cash flows. For positive cash flows. All right. Using the table below. Using the table below. Step two, I will give you the table shortly. Then step two, calculate present value of all negative, present value of all negative cash flows. Then step three, estimates modified internal rate of return using the formula below. Then step four, advice, that is decision rule. Okay, what are the decision rule? Now, let me go back to step one. Let me bring you a table. Oh, I think I have table somewhere before. Yes, let me just copy this. Get out. Okay. I always like my things to align. Okay. So when you are calculating terminal value, you will go to the question and pick. Here will be number of years. So you go to the question and pick the positive cash flows. Item, description of items. Then you have compounding factor. Then you are going to have terminal value, TV. Let me come here. Call this one TV. Terminal value. All right. So when you are calculating your terminal, to calculate your terminal value, so you go to the question, you identify positive cash flows. Let's say you have year one. Let me make this one. Let's say you have year one, year two, year three. Year three is okay. All right. So then, of course, let's say you have all the positive cash flows in your as given to you in the question. Let's say this is 5,000. Here is 4,000. Then year three is 6,000 for simplicity. These are the cash flow generated by the projects. Remember, your intention, you are calculating modified internal rate of return. So your intention is to reinvest the cash flow generated by the project. So you then go to the question, you are going to pick all the positive cash flows, all the cash inflow given to you. It may well be that your cash inflow may be scattered. Maybe in year one, the project generates negative cash flow. In year two, positive. Year three, positive. Year four, negative. So your focus is on the positive cash flow. In any year that the project generates negative cash flow, you are going to ignore it. Okay? Then your compounding factor will be calculated as 1 plus R. Let me see. I think I have raised to power something there. Instead of doing it afresh. Yes. Let me use this one. Okay. So when you are calculating your compounding factor, this is not discounting. Your compounding factor is not the same thing as discounting. So your compounding factor is calculated as 1 plus R raised to power N. So you want to reinvest. You want to reinvest total TV, total terminal value. So you want to reinvest the cash flow generated by the project. Therefore, you need to, let's say, for example, this your compounding factor is 10%. Let's say it is 10%. All right. So therefore, this one will then be equal to 1.10, 1.10 raised to power whatever. I will come back here. I will do it. I will adjust it later, but for now. Now, our intention is to reinvest the cash flow generated by the project. So in year one, this project generated 5,000 naira. You now want to reinvest this 5,000. The assumption is that all this cash flow of 5,000, 4,000, and 6,000 occurs at the end of each year. So this one of 5,000 that the project generated at the end of year one will be reinvested for how many more years? Additional 2 years. So you invest it for year two and also you invest it for year three. So the year that the project or the cash flow occur will not be part of it. Therefore, we can invest this 5,000 naira for additional 2 more years. Therefore, here will then be equal to 2. Then, this cash flow of 4,000, you need to ask yourself, how many more years can you reinvest this 4,000? Remember, this occurs at the end of year two. Therefore, you can only invest this 4,000 for additional 1 year, which is for year three. You invest it for only 1 more year in year three. Again, this one of 6,000 for year three, how many more years can you reinvest it? 0. So here will be equal to 0. Okay. This will be equal to 0. All right. So this is how to calculate compounding factor. So you then bring out your calculator to get your terminal value. You bring out your calculator to say 1.1 raised to power 2 equal, that's 1.21, right? So 1.21 multiplied by 5,000.
6,015 naira.
So this will give us 6,015 naira. So this 6,015 naira represents the amount you have invested plus the benefits. Okay? Plus the benefits. You go to year 2, you start from the compounding factor, which is going to be 1.1, okay, raised to power 1 equal, then multiply by 4,000. This will give us 4,400. Okay, so you have invested 4,000, then you have a benefit of 400. Then the one of year 3, 1.1 raised to power 0. Anything raised to power 0 is equal to 1. So here will be equal to 6,000. All right. We then add up everything together. This will give us 10, 16, 450. I think this is 16,450, right? Yes. So this is how to calculate terminal value, because according to modified internal rate of return, you are reinvesting the cash flow generated by the project. Okay, so once you are done with step 1, once you are done with calculating your terminal value, the next thing you need to do is to then calculate present value of all the positive, of all the negative cash flows. So the same way you normally calculate present value, cash flow multiplied by discount factor, you get your present value. Then once you have your terminal value and present value, you can then go ahead to calculate your modified internal rate of return. So to calculate modified internal rate of return, let me copy this formula. I can use any of these two to do this under the terminal value method. All right. Okay. Let me see. Okay, better. So to calculate modified internal rate of return, this is the formula you are expected to use. N is the useful life of the project. TV is the terminal value. CO is present value of cash outflow. Then, of course, whatever you have minus 1. If I don't want to use that, I can use the other method. I can use the other formula. It's the same thing you are going to get. Okay. Alternatively, I can use the formula here to calculate my modified internal rate of return. Okay. DO is the terminal value. DN is the present value of cash outflow. Then, of course, N is the useful life. All right. So any of this formula will give me the same answer. All right. So that is that. Then, if I'm using, this is the procedures you are supposed to carry out. Let me remove this. I don't need this. Okay. So if I'm using terminal value, this is what you are supposed to do. All right. This is what you are supposed to do. Assess step 1, you calculate terminal value. Step 2, you calculate present value of negative cash flows. Then step 3, you calculate modified internal rate of return using the formula. You have any of the two formulas I provided here. Of course, step 4 will be for you to advise, but I don't want to give that for now. However, if you are using present value method, that's another method, present value method. So what are you supposed to do? Let me put it here for you. Present value method. So using present value method, what are the steps you are supposed to carry out? In this one, I call it step 1. Let me call this one to step 2. Then step 3. Okay. So if I'm using the present value method, what are you supposed to do? Step 1. Okay. Calculate the present value of positive, or calculate present value for all positive cash flows. Cash flows. All right. Step 2. Step 2. Compute. Let me use calculate the present value for all positive. Calculate present value for all positive cash flows. All right. Using, okay, let me do it this way first. Let me go to compute. For step 2, compute PV for negative cash flows. All right, the initial outlay and any other negative cash flow that you may have. Initial outlay. Okay, that's what I mean by negative cash flow. Then step 3. Estimate modify internal rate of return using the formula below. All right. So that's all you need to do. These are the procedures. Okay. Let me give additional information here. This method is suitable. This method is the most suitable where net present value has already been calculated or given. So if in a question you are already you have been given NPV and you have to calculate modified internal rate of return, or if in the question, let's say for example requirement number A, you have to calculate net present value. All right. After calculating the net present value, you are now asked to calculate modified internal rate of return. So under that circumstance, this is present value method is the best method because it's faster, because the present value of cash inflow and the present value of cash outflow you are looking for is already embedded in your NPV. So just pick the number and you move on from there. All right. The steps below can be carried out when calculating modified internal rate of return using PV method. Okay. So like I said, step 1, you calculate the PV of all positive cash flows. Just multiply the cash flow, the cash inflow, you multiply with the discount factor. You get the present value. Then you add up all the present value for positive cash flow. You do the same thing. Now, when you are calculating your positive cash flows, if you are given the company cost of capital, you use the company cost of capital. At times, examiner may give you a reinvestment rate. So that reinvestment rate will supersede the company cost of capital. So for your positive cash flows, you are supposed to use the reinvestment rates. But when you are calculating PV of the negative cash flow, you use the company cost of capital. You don't use reinvestment rate for your negative cash flow because you are not reinvesting you can't reinvest negative cash flow. What you are reinvesting is positive cash flow. So if you are given a reinvestment rate, it is that reinvestment rate you are going to use instead of the company's cost of capital. But if reinvestment rate is not given, then you have to use the company cost of capital. Okay, I believe that is clear. Now, step 3 is to then calculate modified internal rate of return using the formula below. This is the formula you are going to use on the day of your exam. Examiner will, okay, let me do it this way. I say calculate the PV for all positive cash flow, that is reinvestment return phase, that is return phase cash flow. Return phase cash flow. The return phase is the period of the project or is the stage of the project where the project is generating cash inflow. When the company is reaping benefit from the project, that is the return phase of the project. So that's where you are going to have your cash inflow. Your negative cash outflow will arise when the company is spending money on the project. That is the investment phase. This is called investment phase cash flow. Let me remove this so that I don't have double brackets. All right, this is investment phase cash flow. So on the day of your exam, at the back of your question paper, okay, at the back of your question paper, this big for nothing formula will be given to you. You are going to see it there, but it's not going to be called present value of cash inflow. It will be called return phase. All right, it will be called return phase cash flow. Then this one, the denominator, will be called investment phase cash flow. All right. The bottom line is that I like to use cash inflow and cash outflow because in the NPV that you have, in the present value you have calculated, you have cash inflow, you also have cash outflow. So that one is very clear and easy to understand rather than saying return phase and investment phase. Okay, so the present value you have calculated in step 1, that is what you are going to have here. That's your present value of cash inflow. Okay, then the present value you have calculated in step 2, that is your present value of cash outflow raised to power 1 over n. N is the useful life of the project, then multiply by 1 plus the cost of capital. Everything minus 1 will give you the modified internal rate of return. Like I said, this present value method is suitable or is better where in the question you have already calculated net present value or the value of the net present value is given to you. That is when you use this big for nothing formula to calculate your modified internal rate of return. Let me copy this and push it up. Let me push it there. Okay. So finally, the final step to calculate your modified internal rate of return is to then advise. Okay, that will take us to decision rule. All right. So this will have the same decision rule as internal rate of return. If your modified internal rate of return is greater than the company cost of capital, you accept the project. But if your modified internal rate of return is less than the company cost of capital, you reject the project. However, where the modified internal rate of return equates the company cost of capital, the company can either accept or reject the project depending on other qualitative factors, So this is what you need to do as far as the modified internal rate of return is concerned. So let me know if you have any question for me before I proceed to project duration. Okay, let me know if you have any question for me. All right, so of course, by the time we begin calculation, we are going to be doing all the calculation at once. To modify any techniques that we want to, that we are going to discuss. We are going to do the calculation later. For now, let's do a kind of explanation. And for those of you that did financial management at skills level, modified internal rate of return is not part of the scope of FM. All right, so you have to pay particular attention to this. And that's why I try to reframe the content you have in your study material so that you can really drive home the points. Okay. Now, the next thing we want to discuss is project duration. It's not in your learning material. Let me put it here for you. Project duration. So what do you mean by project duration? Let me be fast. This represents the average time taken to recoup or recover the amount invested in a project. The amount invested in a project. So, company may want to know how long it will take them. All right. Company may want to know how long it will take them to recover the amount invested in a project. How long will it take? Okay, how long will it take the company to recover the amount invested in a project? It's similar to normal payback period. But the payback period is just like a measure, it's a liquidity kind of technique. It is focusing on financial risk. All right. That is how quick can the company recover the amount invested in a project. So it's different from project duration. Project duration is talking about time taken to recover. All right. So project duration is more than the payback period, because the focus of payback period is to recover the amount invested. Once the project has recovered the amount invested, then that's end of it. The other cash flow after payback period will not be considered. But project duration, you want to know, and for the entire project, how long will it take you? All right, the average time taken for the company to recover the amount. So, yeah, somebody is raising hand. Yes, talk to me. What's your question?
Yeah, sorry, sir. Please, the project duration, is it the same as project life?
No.
Okay.
Useful life is different. Yeah. Useful life is different. When you say project life, it could be useful life, it could be project life. All right. But project duration is different. Just like when you are executing a project, you need to know the starting point and then the final, when the project will be completed. All right. So it's more like project scheduling. All right. Project duration is more like project scheduling, the starting point and the end point. Okay. From start to finish. Okay. Let me continue. This is similar So the normal payback period, or discounted payback period, except that the project duration considers the entire life of the project. Okay, unlike payback period that ignores the remaining cash flows after payback. Okay, after payback. All right. So how do you then calculate project duration? Calculating, or how to estimating project duration. So how do you calculate project duration? Let's discuss it. Okay. Basically, there are two methods. There are two methods of calculating project duration. Including number one, I'm coming for you because number one, weighted average method. Then number two, present value method. So whichever of the two methods that you use will produce the same answer. Any of the two methods above will produce the same results or the same figure as duration. I don't know if you guys have done bond valuation. If you have done bond valuation, it's similar to, it's the same method of
Yes, we've
calculating.
started.
So if you have started bond duration, so it's the same thing as project, the same way you calculate bond duration is the same way you are going to calculate project duration. The only thing that will be different is the cash flow. Yes, Wilkos, you raised hand the other time. Talk to me quickly. Wilkos. Okay. So using the weighted average method, what are you supposed to do? How do you use weighted average to calculate project duration? Let me give it to you in steps. Step number one. Okay. Step number one, calculate present value. Calculate present value. Okay. Yeah. Then step number two, let me make it a bullet points. Because You are not helping me. You are slowing me down. I've called your name. You did not answer. Talk to me quickly. Because are you hearing me? Or you are muted? I'm not sure you are ready to talk. Because so step number 1, calculate present value of cash flows. Present value of cash inflows. Then step number 2, right? Find the weights. Find the weights of each year. Find the weights of each year present value. This can be done. Because you are raising and I'm asking you to talk. Speak up, talk to me. What's your question? Because
Our network is unsteady. That's what she's saying on the group, sir.
oh, okay. She has started, right? Let me check.
Yes.
Oh, okay. You can send me the charts so that I can address your question. All right. While you are doing that, let me continue. So step 2, find the weight of each present value. How do you do this? This can be done by multiplying the present value with the corresponding number of year. So present value of year 1, for example, you multiply with year 1. Present value of year 2, you multiply with 2. Present value of year 3, you multiply with 3. All right. So that will give you the weights. Then step 3. Step 3 says you should calculate. All right. Estimate project duration. Estimate project duration using the formula below. All right. So which formula is that? Let me copy from the modified. What do I want to do? Okay, I need this. So to get the project duration, I would then pick, I would say duration equal to, let me push this one down. Okay, I will say duration equal to the total weight that I've calculated. Total weights that I've calculated in step 2. All right. Total weights. I would divide it by the total present value. Divided by total present value. Whatever you are going to have, your final answer must be expressed in years. I'm supposed to copy this. Your final answer must be expressed in years. Okay? Let me use this one instead. I need the brackets. All right. So this must be expressed in years. So that will give you the duration. Let me just give you the format here. I said find the weight of each present value. This can be done by multiplying the present value with the corresponding number of years. Okay, the table below, I like to simplify things. The table below can be used to, okay, let me just, yeah. So let me create table. Number of year, cash flow, discount factor, present value, then weights. Let's say we have 5. Okay. Here will be year. All right. Here will be description of items, followed by cash flow, then discount factor. All right, discount factor at whatever percentage, let's say at 10% for simplicity. Then we are going to have the present value. Let me write it out in full. Present value. No, that will be too much. Present value. Then I need additional column. This will be the weights. The weight will be here. Let's say this is A. Let's call this one A. I don't need description of items. Let me remove it. So let's say this is B. This is C. Let's say this is D. D will be equal to B multiplied by C. Turn this one to small capital. Then E will be calculated as A multiplied by D. Okay, that will give me the answer to, that will give me the value of E. Get out. Okay, let me push this one. In fact, let me push everything there. Okay. Let me increase the weight of this one. So let's say, for example, you have year 1. Let's say we have year 1 to 3. So year 1, year 2, year 3. You are given cash flow, for example. Let's say you have cash flow in the first year. Cash flow is 5,000. In the second year, cash flow is 4,000 generated by the projects. In year 3, cash flow is 2,000, right? So then, of course, discount factor for year 1 at 10% will give us 0.909. Year 2, 0.826. Year 3, 0.751. You then multiply to get the present value. Promise, what's the present value of year 1? Multiply for me. Okay, because was saying I should check the last sentence. What did I say there? Okay, this represents the average time taken to recoup or recover the amount invested in a project. It is similar to, let me write this one.
He's talking about
Project
a message in the chat box, not your own
Yeah.
write-up.
Oh, okay. Project duration is similar to the normal payback period or discounted normal payback or discounted payback period. except that the project duration consider the entire life of the project, unlike payback period that ignores the remaining, okay, something is missing, the remaining cash flow. The remaining cash flow after payback. All right. I think that's what she's trying to communicate. Yes. What's the present value for 5,000?
4,545.
4,
545.
5. Okay. So 4,545 multiplied by 1 will give us 4,545. Then the second one,
3304.
33.
04. 3,304.
Multiplied by 2.
6608.
Then 2,000 multiplied by 0.751.
1502.
1502.
1502. Multiplied by 3.
4,506.
4506.
506. So you then add up. You add up the present value. You also add up the duration. So add up the duration, then add up the present value. What do you have there?
15,659 for weight.
15,659. 15,659. All right. Then the total present value. Yes.
9351.
9355. All right.
51.
51. So step 3 says you should then estimate project duration using the formula below. This is just hypothetical figures. So I would then come here. For me to get my duration, I would then come here to say, after expressing my formula, I will just input the numbers, and that's all. It's no more than this. It's no more than this. The same thing you are going, if you are calculating bond duration, it's the same method you are going to apply. So the total weight in this case is 15,659. Then total present value is 9351. So what do we have here as your duration?
1.67.
1.67. Here will be 1.67. So you then say 1.67 years. So that means it will take this project, it will take the company 1.67 years to recover the amount invested in the project. Okay, it will take the company to recover the amount invested in the project within 2 years. All right, so this is how to calculate project duration using the weighted average method. The second method, which is present value method. Let me copy this. Let me copy all of this. All right, move to the next page. So if I'm using present value method to calculate project duration, what are you supposed to do? All right. So step 1, under this, step 1 is to calculate present value of cash inflows. All right. Then step 2, you calculate or you find the proportion. Find the proportion of the present value of each year, present value of each year to the total present value. Find the proportion of each year to the total present value. Then step 3, determine, step 3, calculates the project duration, the project's duration by multiplying the proportion, by multiplying the proportion of PV with the corresponding number of years, okay? So the table below can be used to calculate the duration. The table below can be used to determine the duration. All right. It's no more than this using the present value method. So in this case, I need to introduce additional column. Let's say we are still using the same hypothetical figures. Okay, so here will be proportion of PV. Proportion of PV. All right. So let's say this one is E. Okay, let's say this is E. E will be computed as, no, don't need, that is E. Then this one will be F. This F is the duration you are looking for. So it's no more than that. So to get the F will then be equal to A multiplied by E. That will give you the duration you are looking for. So let's do it together. So well, we maintain existing cash flow, these hypothetical figures we have here. All right. Let me push this one up. So this proportion will be in percentage. Okay, to be in percentage. All right. Now, the next thing we need to do. So like I said, in this step number 3, you are supposed to multiply. Okay, you are supposed to divide rather the present value of each year with the total present value. Therefore, 4545 divided by 9351. What do you have there?
I have 48.6%.
0.48
486.
what? That's
6.
49. So that's 49, 2 decimal points. If you like, you can make it 3 decimal points. But at all time, whatever you are going to have, your final answer must be equal to 1. Okay, 100%. The next one, 3304 divided by 9351. What do you have?
0.35%.
0.35. The last one, 1502 divided by 9351.
0.16%.
1 6. So when you add it up, are they equal to 1? 16, that's 51. Yes, that's 100%. So that's that. So you then multiply this proportion of 0.49, you multiply with 1. That will give us 0.49. Okay.
Yes.
Then the second one, 0.35 multiplied by 2. What do you have?
0.7.
0.7, right? Then 0.16 multiplied by 3,
0.48.
0.48. Add everything together. What do you have?
1.67.
1.67. So you can then come here. You can then come here to say that project duration, the project's duration is 1.67. 1.67 years. You know that the same thing we calculated before here. So, like I said, whether you use weighted average method or present value method, you are going to arrive at the same answer. All right. So this is how to calculate project duration. No matter how big is the question, if you're asked to calculate project duration, this is how to do it. Okay. So that is as per that. Now, one more important thing you need to know as far as project duration is concerned. Notes. I'm not sure I have it in this material. Let me check. Okay. You don't even have a duration here. So let me just give you. Now, one important thing you need to know is that when you are given a negative cash flow in the first year, right? When you are given negative cash flow in the first year, you don't include negative cash flow when you are calculating project duration. You don't consider negative cash flow in the first year. But if the negative cash flow occurs in year 2, that is after the project started generating positive cash flow, so that negative cash flow in year 2 should be included in your project duration calculation. So in effect, what I'm trying to say is that negative cash flow should not be considered in year 1 when calculating project duration, except the negative cash flow occurs in between years. So note that. Let me put it down for you so that you don't forget. ICANN has never tested project duration before under capital budgeting, but of course, under bond duration, yes. So let me put it down for you. When negative cash flow occurs in year 1, it should not be included in the calculation of project's duration. Okay. However, if the negative cash flow arises after the project generates, or after it, let me put it this way, after a positive cash flow, the negative cash flow should be included in the calculation. So, calculation. All right. Should be included. All right. So that's what you need to do. As far as duration is concerned, get out. So as far as duration is concerned, so let me reinforce my points. So what we are trying to say here is that if, for example, in the first year, a project generates positive cash flow, let me see if I can put it down. There's no need. So let's say, for example, a project generates positive cash flow in year 1. Then in year 2, you have a negative cash flow. Year 3, you have positive. Year 4, you have positive. So the negative cash flow you have in year 2 will be included in the project. But okay, let me just, for example, I'm very magnanimous. Let me use a table to demonstrate that. Okay. Scenario, let me call this one scenario 1. Yeah, you come here. All right, let me call this one scenario 1. So in this scenario, in this circumstance, we have number of year and we're also given cash flow. Okay, so cash flow in year 1, let's say cash flow in year 1 is negative 2,000. We are given a negative 2,000 in the first year. All right, then year 2, 3, and 4, we have a positive cash flow. All right, so when I'm calculating project duration, I will not include year 1 cash flow because year 1 is negative. Okay, I will not include year 1 cash flow under this. So let me just put it down. The negative cash flow. The negative cash flow in year 1 will not be included, will not be included in the calculation of duration. All right. So let's say we also have another scenario. We have scenario number 2, whereby in this scenario number 2, cash flow in year 1 is 5,000 naira. Cash flow in year 2 is 4,000 negative. All right, 4,000 negative. So because the negative cash flow does not arise in the first year, all right, so you are going to include the negative cash flow in your calculation. So you then say the negative cash flow in year 2, the negative cash flow in year 1, I did not put 1 there. The negative cash flow in year 2 will be included or should be included in the calculation since it occurs after a positive cash flow has been generated in the first year. So that's what I'm trying to communicate in my grammar above. Okay. So that is that scenario. Let me give you another scenario. So let's say, let me copy the first one. Scenario number 3. Let's say, for example, in the first year, this project generates negative cash flow of 2,000. In the second year, the project generates negative cash flow of 1,000. Okay? Of course, in this case, you will only consider the cash flow of year 3 and 4. The negative cash flow of year 1 and 2 will not be included in the calculation of the duration. So, yeah, the negative cash flows in year 1 and 2 in the table above will not be included in the calculation of project duration. Only cash flow of year 3 and 4 will be considered. Okay, so watch out for that. So that is that. I think this scenario 3 is okay. All right. So what I'm trying to say in essence here is that provided the first year cash flow is positive, any other negative cash flow, irrespective of when it occurs, provided it is not in year 1, should be included in your project duration calculation. But if the negative cash flow occurs in the first year, it should not be considered. All right. So that is as per that. And then in our next, this is where we are going to call it a day. In our next class, by the grace of God, we are going to discuss discounted payback period. Okay, I can see discounted payback period is not much. Let me just complete it here. We still have about 4 minutes more. So let's just discuss discounted payback period. Ordinarily, I would have loved to have explained normal payback period before we discussing discounted payback. But in any case, let's just do this. Discounted payback period. So what do you mean by discounted payback period? This represents the number of years it will take a project to recover the amount invested in a project. Okay? The discounted payback period is usually calculated as the normal payback period, except that the cash flows are discounted to the present value equivalent before calculating the payback period. Payback period. This means that present value is used to recover the amounts invested in a project instead of the normal cash flow. Okay, instead of using cash flows. All right, so that's that. So how do you then calculate payback period? So when we meet next week, by the grace of God, we're going to be discussing that. All right, so this is where we are going to call it a day. Let me know if you have any question for me. Other than that, let me see, some of you have disappeared, but a handful of you are still here with me. Yeah, I can see Abiodun. I can see Ayodele, Oluwatosin, Abigail, God's Power, Raphael, Praise, and Binta. Binta, how are you? Hope you are coming back this week, Binta. Yes, Esther, Esiafa, Faith, Accommodate, Glory, how are you? Ida, Ibrahim, Muhammad, Idrisu, Yakubo, Ife, Mayowa, Kenny, Olatunbosun, Oluwabukola, Oluwatosin, Oluwayemi, Folusho, Wilcox, Oreoluwa Tofumi. I have Precious, I have Promise, I have Idrisu, that's Rabiat, I have Rukoya, I have Taiwo, I have Temitope, I have Toluwani, I have Paul, Victoria is here with me, Zoom user, is that Mopilola? Zoom user, okay. So this is where we are going to call it a day. And before I let you go, I will encourage you guys, to get a copy of the Golden Book. It's going to help you a lot. Don't take any chance on strategic financial management. The Strategic Financial Management Golden Book is highly simplified. There's no material on SFM that is as simplified as the Golden Book. So I'm encouraging you to get it on time and start using it. Wherever you are, we can deliver to your location. All right, it's available in hard copy. It's just 15,000 naira. If you want it in the ebook, the soft copy PDF, you can also get that at 8,000. But the ebook has expiry dates. It will expire 31st of December, and it's 8,000 naira. So anything you want on strategic financial management, for you to as simplify as you want it. If you want to learn, you really want to know strategic financial management, then you need the Golden Book. It will help you greatly. There is no topic you want in SFM that you're not going to see there in a simplified form. So get it on time and then start using it. It's going to help you a lot. All right, so this is where we are going to call it a day. I will see you next time by the grace of God. And then again, if you need a copy of the Golden Book, just send me the WhatsApp chat. If you don't have my contacts, let me put it down for you. Sorry, I'm not using pen here. Okay, so my contact is just you can reach me on 070 Let me stop sharing this. So you can reach me on 070 64. Let me write it down somewhere for you. Yes, my number is even here. So this is my number here. You can reach me on any of these numbers. So you'll get your copy. 07064972788 or 07080868079. Any of this number, reach out to me to get your copy and start using it. It's about 765 pages. It's a big material, all right? So well simplified, consistent, and compliant with ICANN SFM syllabus. Okay, guys, I will see you next time by the grace of God. Good night to every one of you. Bye-bye.
Good night, sir. Bye.
Yes, promise. Good night.
Good night, sir.
Yeah, good night, Brian.
Good night, sir.
Stop recording. Yeah, Glory.